All right, that's generally my cue to start. Okay. Okay, it's 1 o'clock, so let's get started. Thank you all for coming to this IEO webinar on the global housing boom. Is it time to worry? We have a speaker from the IMF as well as 3 discussants from outside. So we'll start with Denise Egan, who is the chief of the Systemic Issues Division in the Research Department. And I think of all the people at the fund, currently she has been the one who has been in a very dedicated way following the housing markets for well over a decade. She has worked on the Netherlands team, doing the Article 4 there and doing a very nice issues paper on selected issues paper on housing, as well as she kind of flagged some of the events in Dubai that happened a while ago. So she has really had her eye on the ball and has received the IMF's research award for her work on risks, on flagging risks in real estate markets. She also is a panelist for Zillow's House Price Expectations Survey. So with that, over to you, Denise, and thanks very much for making time to do this. Up to you.
Thank you, Prakash. Let me start by thanking you as well as the other panelists for making the time, and the audience for making the time to join. And I look forward to a lively discussion. So I hope you will be able to see my screen. If not, give me a heads up.
Yeah, we can see it.
Okay, perfect.
Denise, you might, if you could speak up just a little bit, I think.
Okay, can you hear me clear?
Yeah, go ahead.
Okay, great. So today I'm going to basically walk you through a little bit what we have been doing over the past year once the pandemic hit. And we've been looking at the economy from very different perspectives, of course, from every angle we can think of, and real estate markets was also one part of it. So I'll walk you through how we started thinking about it, and then the most recent indicators and where we see the most recent developments going in a certain direction or not. And before I start, of course, the disclaimer, these are our views and do not reflect the views of IMF management or the executive board. And this is joint work with Nina Biljanovska and Chenxu, my colleagues in the research department. And I hope they are in the audience, if I'm not mistaken. I saw them just a second ago. So what did we expect in an unprecedented year to happen in real estate markets? When we were faced with that question, we went kind of, going back to basics, supply and demand, and credit conditions, what could potentially happen. And in a nutshell, what we thought was it was not easy to say when it came to housing markets, to the residential segment. We could see factors driving prices both in a downward way or an upward way. While on the commercial real estate segment, we thought the balance was more on the downward pressure side, but that would still leave open the question whether such downward pressure would be transitory or permanent. What do I mean by that? Talking a bit more in detail. So in the residential real estate side, first downward pressure, we felt that the disruption we were observing in activity and the spike in unemployment in many countries could lead to a rise in delinquencies and defaults, as well as a decline in demand for housing, generally speaking, because of the loss in income and uncertainty. And the decline in demand could also be intensified if the lockdown measures or the voluntary part of social distancing would put limits on in-person viewing of properties or completion of transactions. Although looking back, there are anecdotal evidence and notes that in-person viewing of properties has not been a big obstacle, and a third of recent buyers reportedly did not even see the property they ended up buying before they made the decision to do so. But even if, this demand factor, the real demand factor was not there, we could also see a credit channel. And if household access to credit was restricted by tighter lending standards because their prospect for employment and income was worsening, then we could still see some downward pressure, and in the worst case scenario, some forced sales as households faced with a liquidity crunch would be forced to put their property in the market and take a lower price. On the upward side, we felt that the decline in demand could be offset by the lower supply from slowdown in construction activity. And perhaps in some countries, in some locations where we were already observing some lag in supply, that could be even more pronounced. In addition, the fiscal support to households and both voluntary and publicly assisted loan forbearance could help prevent an increase in distressed transactions. And of course, on the monetary policy side, lower mortgage rates could ease debt service burden, improve affordability, and alleviate the downward pressure on house prices. This is, of course, talking about the aggregate, but we also felt that as the pandemic evolved, we could see a shift in housing preferences if people believe that a second wave, a third wave would bring another round of stay-at-home orders and we're moving to a new normal in the post-COVID world, then we could see more demand for bigger houses, suburban areas, as opposed to city centers. But it was not, of course, it remains to be seen, and I'll show you some evidence, early evidence, where we're seeing such reallocation happening. But as I said, on the balance, we didn't know which way things would go. On the commercial side, our expectation was that the severe disruption in economic activity would reduce price of commercial real estate, and it would bring down business earnings, increase the need for credit to weather the downturn, and the impact on some sectors, such as hospitality and retail, would be much more pronounced than in other sectors. And of course, things would depend on the persistence of the shock. If it's just a transitory thing and then we're going back to pre-pandemic normal, then government programs and liquidity type of loans could help firms weather this out. But if persistent, then we would potentially see defaults and downward pressure on the prices. And April GFSR actually delved into it a little bit better in more detail and documented some pressure, the downward pressure, and potential financial stability implications from there. We're still not out of the woods, right? We're still working from home, and although there are many announcements of plans to go back to the office, things may not go back to where they were before the pandemic. And if that happens, we might still be looking into some additional downward pressure that has not materialized yet. So with that kind of conceptual thinking, evidence at the end of 2020 points to a relatively short-lived downturn in activity, and that happened with little or no negative impact on residential real estate prices, but there was notable downward pressure on commercial real estate. Halfway into 2021, we are now seeing signs of a turnaround, and similar to some other parts of the economy, residential real estate activity rebounded after a very sharp decline, but it also rebounded very strongly. And this pattern is pretty broad-based. Of course, there are exceptions, but we see it in a range of countries, and it's reflected in undisrupted, even accelerating increase in house prices, although rents have stagnated. And that's what you see in the slide. When we look at a global scale, you see the acceleration in prices, whereas the price-rent ratio has been increasing faster than price-income ratio, pointing to the stagnation in rents in many countries. Now, while residential prices are up, it's not the same in all segments. And we're seeing this upward pressure, especially in single-family houses. And this is most of the case for Northern America and Europe. And some Asian countries, for example, Korea, is showing the opposite pattern when we look at the price growth we observed since the beginning of 2020 in houses versus apartments. Whereas in the commercial estate, as I mentioned, we did have a short-lived distress, but even the hardest hit segment seems to be coming back to pre-COVID levels. But again, this is mostly the case for Western Hemisphere and Europe. Asia has still some room to recover, while in the Middle East and Africa, we had a downward trend even before the pandemic, and that seems to be stabilizing in that lower level. So what is next for this hardest hit CRE segment, commercial estate segment? When we look into the details, the breakdown, we see that lodging and resorts showed a strong performance, especially after vaccine news, but they remain very sensitive to sentiment. Office and retail is not out of the woods, as I mentioned, and limited data so far is showing a pressure on rent, and some companies are or maybe switching to some significant part of their workforce permanently to work from home arrangements. Now, let's take a closer look at the U.S. on what might be, just to get a sense of what might be driving the pressure on residential real estate prices. So you have seen in the news, I'm sure there are a lot of people in the audience who are based in the U.S., so it's difficult to not hear it, or maybe you heard from your neighbors or whatnot. But the one factor that made headlines in the U.S. for the increase or the heated housing market has been the fact that inventory has been very tight. And this is especially the case for single-family homes. And actually, the number of days in the market before a property is sold has declined so rapidly and to an unprecedented level, again, in an unprecedented year. And we didn't see it as much for condos, but definitely for single-family homes and to a lesser extent in townhouses. The other potential factor is construction material costs. And when you look at the, inflation concerns have been in the news as well, but when we particularly look at the breakdown and then see what has been going on for example, plywood and lumber, the increases have been really striking. And this could potentially be a part of the pressure that we're seeing in prices as well. And related to that, the low construction activity because of lockdowns exacerbated the already tight inventory because of the sluggish construction activity that has been happening even before the pandemic. And finally, of course, the interest rates, the low interest rates and the shoot up in household saving rate. I'll come back to the interest rates a little bit later in a global context as well. The question, of course, that whether these pressures, these factors are going to be temporary or permanent, and that remains to be seen. Now, moving to a little bit to the reallocation geographically that I had talked about. Now, we look at the surveys and patterns observed so far, and what we see is that there might actually be happening, some significant shifts might be happening related to, if you wish, to permanent telework. And according to some estimates, 25% of the workforce could be working remotely full-time, even after we're totally out of the COVID world. This is 10% more than what was the case before COVID. And housing preferences are also affected as a result of this pattern. And half of remote working home buyers are saying that their decision to move to a different home or where to buy a new home was affected by work from home arrangements. And this is in line with the divergences we showed in the international scale between houses and apartments. A more granular look by Gupta and others in a recent NBR paper suggests that the within city patterns are also in line with what you would expect, in the sense that here we're looking at the map of New York City and San Francisco, and you see the city core with the red. So not so much increase in house prices or in decline. Rents decline even more, whereas the donuts around the core city areas have seen prices increasing. And interestingly, when they look at the link between distance to the city center and between rents and prices, you can see that the link between the two has been weakening, especially for rent. So this suggests that people are willing to pay more, even if they are farther away from the city center. Now the question is, are we really looking into a permanent urban exodus? That remains to be seen. There were some reports of migration out of New York City, migration out of San Francisco, but some recent reports also suggesting those are not being reversed. So we'll see how things will evolve there. Now, going back to the global picture, we've seen strong price growth over the last year in most parts of the Northern Hemisphere, as you can see in the map. How worried should we be that this is an indication of another house price bubble in multiple countries? Well, one concern could be that where we're seeing price growth today are the places where we already thought housing markets were overheated. Now we can look at a very simple metric exercise, look at the price-income ratio, price-rent ratio, maybe some regression model, and assign countries into different buckets based on those indicators. Perhaps comfortingly, I'm going to say what you see in the plot with the cloud of little dots with no significant pattern is actually somewhat comforting, because we do not detect a systematic relation between pre-pandemic indicators of house price misalignment and the growth since the pandemic. Now, I mentioned interest rates, and I said I would come back to it. Now, the question is, to what extent was the increase in house prices driven by the decline in interest rates? We do observe larger increases in house prices when mortgage rates are lower. You can see that in the plot on the left-hand side. And what is interesting, shown on the right-hand side, is that the relationship between interest rates and house prices seems to have strengthened over the past year compared to what we had observed before. Now the question then becomes, are we looking at a potential correction if interest rates were to increase? Well, it depends on in what context interest rates are increasing, but the likely outcome we feel is that an increase in borrowing costs will have a cooling effect on house prices. And in terms of magnitude, we're potentially looking at 100 basis point change would typically have a 1.5% impact on house price growth. Now, is this time different? We're going to talk more about it, but just to leave you with one picture, and that's based on work that we had done at the IMF and others at the BIS and academics, showing the link between household credit booms and house price booms, which Alessandro will also talk about. The concern always is that, the key is the leverage, and because it amplifies movements in both directions. And before the GFC, in the 5 years leading up to the GFC, we did see the strong relationship where credit to GDP ratios increased more. We saw more house price increases. Whereas in the 5 years before COVID, that relationship, if it exists, is actually in the opposite direction. So again, this is somewhat comforting, but only on one factor. The thing, of course, we talked about credit. In addition to its amount, the quantity, we can also think about the quality of it, right? And mortgage activity this time is not driven as much by risky borrowers, but actually the least risky. For example, in the US, when you look at the mortgage origination by credit score, the green bar you see there is good news, because those are the people, households with high credit scores, as opposed to the 2003-2004 period where we were seeing the subprime borrowing increasing. In an international sense, when we look at the household debt service, again, it's comforting news because we do see the household debt service in percent of income being lower today than it was before the GFC. Now, this all seems to be pointing to good news, I guess, but as usual, we need to be careful. One thing that I didn't show you a picture of, but you have heard probably all around, is that the banking sector itself, or the financial system as a whole, at least on paper, is also looking safer, more sound, more resilient than it was before the GFC. So let me wrap up. Obviously, real estate markets are in the up phase. And at the beginning of the pandemic, we argued it could go either way. But it seems to be that, at least on the residential side, we are seeing signs of strong housing demand combined with supply side issues. And this combination is reflecting, in part, the policy measures, the policy support measures that were taken, but also a continuation of pre-pandemic trends. And this has been pushing prices up. Now, there are a number of factors that mitigate the concerns when it comes to macro-financial risk. It's talked about the household and bank balance sheets being in better shape, but we cannot rule out the possibility that a correction could happen and disrupt the economy. So let me stop here and maybe just two more pieces of food for thought. End of foreclosure moratoria and forbearance is going to be an important factor to watch that could change the equilibrium here. And another issue to watch with social implications is the fact that the move from city centers to less dense areas could have implications for inequality, if you think that it's the richer, more educated, more skilled workforce moving to those areas where house prices are cheaper and may create some forces that could increase inequality. So with that, let me stop here and give the floor back to Dr. Prakash.
Thanks very much, Denise. As always, very clear and concise presentation of your findings. I'm now going to turn to Enrique Martinez. He's a senior research economist and advisor at the Dallas Fed. He's an economics PhD from Wisconsin-Madison. And like the IMF, he and his colleagues at the Dallas Fed have, over the past decade or more even, been maintaining an international house price database. So I think I'm not aware of other regional Feds having something similar, but the Dallas Fed has a globalization center. And I think as part of those activities, they have been very in the forefront of looking at housing markets, not just in the US, but all over the world. So Enrique, I mean, can you sort of both give us some reactions to Denise's presentations and also tell us from the Dallas Fed's view how things look globally for real estate markets? You heard from Denise that there may be some reasons to be less worried this time than during the global financial crisis. So give us your view. Over to you, Enrique.
Thank you so much. Yes, let me share some slides first. While I put that together, let me start by thanking you for inviting me. It's a great it's great to be here. It's great to be here and to give you my 2 cents on the outlook for global housing. It's also great to be here as a learning experience. We have a very distinguished number of speakers. I'm sure I'm going to learn a great deal from them, as I did from the work that Denise has already presented. Before I get ahead of myself, let me just give you the usual disclaimer that what I'm telling you here is my views and not necessarily those of anybody else affiliated with the Federal Reserve Bank of Dallas or the Federal Reserve System. The piece I probably want to narrow my comments on is residential housing, and in particular, this idea of whether we should be particularly worried about developments in house prices that are not just specific to the US, that are fairly widespread among many advanced countries, particularly in Western Europe and North America, as Denise just showed us. And I just wanted to present a very simple chart of the evolution of house prices, real house prices in growth rates, just to elicit the conversation or to reframe the conversation. Is this, in the following terms, is this reminiscent of episodes of booms in the housing market that were fairly widespread as the ones that predated the 2007-2009 recession, or the house price boom in the late 80s that many advanced countries also went through, or not? And I think Denise has done a fantastic job, actually, at laying out some of the forces at play. I will just build on that, adding one small twist, perhaps, to the discussion. By some metrics, if you look at the growth rates, these growth rates are fairly high across the board and comparable to some of the growth rates that we've seen in the previous experience. Having good measures of prices is critical. Having a metric to try to assess or to put in context the evolution of prices can be very useful as well. And that's where I'm going to sort of take a minute to market some of the work that we've been done at the Dallas Fed and in collaboration with partners at the University of Lancaster to develop statistical techniques aimed at giving us some metric of what I will describe as housing fever. So as Denise mentioned, there are ways in which you can assess whether these prices seem to be out of step with fundamentals by relating them to known fundamentals on the housing market. Another approach that you can take, which is the one I'm going to build on here, is based on a purely or more statistical view at the data. So if you are concerned about episodes in which house prices become out of step with fundamentals, if you are concerned about the emergence of a type of bubble in the housing market, then what are the properties that you would expect to detect in the time series? And can you devise the statistical tools that will allow you to detect breaks in the time series that behave as you would expect them to behave if a bubble were to emerge? And the one particular type of test or class of test that we like to use, refer to, is aimed to detect or identify periods within the sample that look like house prices are behaving in an explosive fashion or manner. So with that sort of broad explanation, let me just take a closer look at this upswing in house prices. If we apply these techniques, which I often relate to like taking the temperature on a patient, like having a thermometer put on the patient, what is it that we look behind these aggregate numbers, these aggregate growth rates? And what we see is very much something consistent with what Denise was telling us, that the countries that seem to have developed signs of a fever during the pandemic, in some cases even predating the pandemic, are countries in North America, countries in Northern Europe. Big exceptions in Europe being perhaps Spain or Italy, and for reasons very specific to those countries, I would say. Now, one has to consider the same way that you would use a thermometer to give you some warning about the health of a patient. The fact that you have a reading of fever, even if you take it as reliable, I hope you do, we certainly do, that doesn't necessarily mean the patient is sick. That doesn't necessarily mean the patient is going to need to go to the doctor. So you need to dig a little bit deeper, I would say, in what is different this time from what we had seen in previous episodes. Where prices seem to behave in an explosive manner. And I think I'm going to build very much on the story that Denise was articulating early on. At the end of the day, this recession has been very unique. The countries that seem to be experiencing a stronger house price appreciation, that seem to be given as signals of fever in housing markets, are countries that have dealt with the impact of the pandemic with significant degrees of fiscal and even monetary stimulus. The implication of that, or the practical implication, is a lot of these countries have experienced very large increases in disposable income during the pandemic and significantly low interest rates. So you have a scenario where two of the key drivers of housing demand seem to have become more supportive of demanding housing markets at a time where I would argue the restrictions imposed by the response to the health crisis, the lockdowns and so forth, had the effect of both limiting the opportunities to consume for households broadly, meaning a lot of this additional income has ended up being parked as savings and ultimately potentially could have even been allocated to investment vehicles tied to housing markets. But at the same time, you had a situation where the supply, and here I have just a couple of serious housing permits and real residential investment to illustrate that point, had been severely constrained across many of these countries, across all of these countries. There is a robust bounce back that seems to be happening in the later part of 2020 already, as some of these lockdown restrictions have become to be lifted, and there are positive signs evolving over time. As the vaccination rates keep increasing and things seem to be getting further back on track. So one way to look at this, one way that you would say is the benign way of looking at the 2020 experience and what the implications might be for the future, is that the sort of imbalances between housing demand and housing supply are ultimately one important driver of this housing fever that we are detecting. And to the extent that you can catch up, that supply catches up with demand over time, as these restrictions get lifted, some of these markets might end up cooling down on their own without necessarily resulting in a major correction. Now, that's sort of the benign view. I want to mention a couple of things on all of these, sort of as closing remarks, as part of my closing remarks. is one is, and Deniz did a great job pointing this out, the supply and demand imbalances that which I alluded to can be a very important source, but there are other trends with the data that we still are uncertain how they will play out. There is a risk, as Denise mentioned, that there might be another wave of the pandemic if the new variants of the viruses escape the available vaccines, shall we say. Or it could also be that some of the trends that predated the recession, but that have been in some respects accelerated, like lifestyle changes and in particular work from home arrangements, might have implications for housing markets that we still have not fully worked out. Now, in all of this, there is a great deal of uncertainty. That's the main point. The other thing I wanted to sort of highlight is that when we look at housing markets, I think it's often useful. I find it very useful, although sometimes the limitation is the data, to get as closer to the local markets as you can. And we can do a bit of that for the US. I'll show you a few images in a second. And as you look much closer, there is signs that in markets like the US, this housing fever was already present to some extent at a localized level in the data, even before the pandemic. So the cautionary tale that I would make is that there are fundamental causes that might be unrelated to the response of monetary and fiscal policy during 2020 that still might need to be worked out, whose implications we don't know, and which the recession may or may not have aggravated. So there is a great deal of uncertainty on this. But let me show you some of what I mean with this graph. So if you look at the more than 300 metropolitan statistical areas in the US, and you classify it independent of whether we find signs of housing fever or not, through the particular lens of the metric of which I alluded before, there were already significant areas within the US by the end of 2019 that were showing signs that the house prices were looking like explosive. And a lot of this, if you start looking at this, is not the usual places where you would see house prices, where you would have seen house prices heat up in the before the 2007 correction in the housing markets. It's not Florida, it's not the area around New York, it's not at the West Coast where you see most of this. Is areas around some of these major metropolitan areas, some of which are areas that have attracted a lot of migration in recent years. The case of Dallas is perhaps paradigmatic of this. Now, when you go to the map in 2021, it has heated up a great deal. As I said, some of this might be expected and tied to how policy has played out during the pandemic, in the response to the pandemic. But the concern I leave you with is that there seems to be something that is unrelated to the pandemic itself that we still need to figure out. I will say just one small thing on this, which I find interesting, and I very much like the observation that Denise made about how cities that used to be considered bubbly previously now seem to have behaved rather differently. We actually do observe very much the same phenomena. Places like Chicago, Minneapolis, Seattle, San Francisco, even New York, have developed, if at all, signs of fever much later than many other parts of the United States. It's interesting, and it might be reflective of some of these relocation patterns that Denise was talking about. And I leave it at that. Thank you so much, Prakash.
Thanks very much, Enrique. It's really great work that you and your colleagues are doing at the Dallas Fed, illustrating not just the global picture, but the county by county picture within the US. So we're going to turn now to kind of getting down, not quite at a very detailed local level, but at least at the level of specific countries. So let me turn to Brett House, who's Vice President and Deputy Chief Economist at Scotiabank. He's kind of my go-to guy on many housing issues because he knows housing and he knows the IMF. He was an economist here, as many of you in the audience will remember. He's also a Rhodes Scholar, and he was named a Young Global Leader by the World Economic Forum. So Brett, Canada was flashing red on Denise's map, and according to Enrique, as housing fever. So can you tell us a bit more about what's going on in your home country? Up to you, over to you.
Well, thanks for having me, Prakash, and it's great to see everyone and be part of this conversation. Canada has been flashing red for an awfully long time, and so the question I want to pose and respond to is not so much why is this time potentially different, but rather in Canada's case, why is it more of the same? After a good 15 years of appearing along with Australia and New Zealand at the top of many indices of potential housing bubbles, we've continued to see housing markets move ahead strongly in our major cities, which, given the size of the real estate market and the credit market in GDP in Canada, is very much a macro stability issue, not just a micro issue by any means. And certainly for a large Canadian bank, it's an existential issue. So it's one that we do follow very closely. I'll start sharing my slides here, and we'll take you quickly through a few pictures that try to pin down how Canadians are thinking about real estate and building on some of the analysis that we just saw in the first two presentations to go beyond some of the price income, price rent ratios, to understand a bit more of what is happening on supply and demand and on household balance sheets, and foreshadowing a bit of Alessandro's remarks, the impact of QE on housing and asset prices more generally. So moving into the first slides, and do flag if anything isn't displaying properly. We've seen a nearly 24% increase in house prices across Canada as a whole, focused, as in the US, on single family dwellings rather than condos or apartments. And I guess what I want to do is set that big increase during the pandemic into a longer historical context in view of those indices that have been saying Vancouver, Toronto, and some of our other large cities have been in bubble territory for some time, and come back to a very fundamental look at supply and demand analysis, and consistent with some of the work we did at the fund back in the old standby operations division, balance sheet analysis. Part of the consistently high rate of increase in house prices in Canada comes out of what are pretty restrictive and fairly prudent macroprudential controls on the financial sector from the regulators in Canada that meant 2008 passed here without major pullback in housing markets or in lending into them. And until very recently, if we look at the middle chart here on this slide, the extent to which and the pace by which new housing stock is coming into the market has been relatively slow with respect to the ongoing increase in Canadian population, where Canada has led the G7 in population growth for several years. And about 75% of that is driven by increases in immigration into the country, which particularly moved forward during the Trump era in the US, where Canada took the opportunity to rise, we hope, from being a second best choice to the US to a first best choice, with a much more permissive immigration system and a focus on skilled immigrants. The combination of slow building, which is in many ways a byproduct of micro issues around slow planning, difficult zoning, and slow approval processes, has resulted in, as the right-hand chart shows, a persistently low level of residential inventory when you add both new completions and resales together. So the sketch I'm going to lay out here is really one of high housing prices and strong growth in housing prices being driven by the most fundamental of supply and demand imbalances, an imbalance that's likely to be sustained over a substantial period of time and is disconnected in some ways from what price income or price rent ratios typically do and typically flash as problems. Canada actually has the lowest housing stock on a per capita basis out of the G7. And to some extent, that is a reflection of some, let's say, inappropriate mixes in the housing stock between urban dwellings and holiday homes, and between the type of housing that's needed for the size of families that exist in Canada, where the per capita, or the number of people per home, has tended to go down substantially in our major cities, along with low birth rates and smaller families. If you look at Toronto and Vancouver, our two biggest cities that are always in the spotlight, you have seen that run up in housing prices characterized by the two colored lines here, reflected in the prices in both cities, but they're by no means near some of the strongest highs that we've seen over the last decade or so. And part of what has moderated them has been a slightly lagged flow of listings into the market, represented by that ratio of sales to listings in the dashed line. So some of that is entirely anticipated. After the initial onslaught of the pandemic passed through, we did see the beginning of more listings come back in as people were more comfortable having people in their homes or contemplated moving homes themselves. Set again in population context, looking at Toronto and Vancouver specifically, the adjusted inventory in Vancouver on the upper left for population, and for Toronto in the lower right in green, are at or near 20-year lows. So again, regardless of what's happening to incomes, which are clearly not keeping up in Canada with what housing prices are doing, we do have a structural supply-demand imbalance that is being fed to some extent by international capital coming in, but it looks like a relatively small piece of the puzzle here, but still very high immigration rates coming into the country. And one of the macro issues we have to try to get our heads around now is how we maintain the social and political license for high immigration rates, which have been critical to Canadian growth and long-term fiscal sustainability, without blowing up housing markets even further and creating a situation where people equate unaffordable housing in our major cities with pressure from immigration. And you're seeing some price response in terms of new completions in the Vancouver market here, some in the Toronto market in the red line charts, but still, coming off a very, very low level coming into the pandemic. So still a number of structural issues on the supply side that are not meeting the price signals and demand that are exited in the market. This is only going to heat up as we go into the next few years, because if we look at the left-hand side chart here, you can see that admissions of new residents into Canada with permanent resident status have, over the course of the pandemic, as shown by the red line, been at their lowest numbers in over 5 years. They started spiking again on the right-hand side chart as we moved some people with long-term visas into permanent resident status earlier this year to try to catch up from the pandemic. But as we go back to levels similar to those sketched out in 2019 here by the black line on the left-hand side chart, we are going to see those price pressures heat up again even further, or at least sustain the price levels that we have now. It's very, very difficult to put together a set of equations that would see prices coming down, or, if we want to be more extreme, bubbles popping. That's also likely to be fueled by, as Denise mentioned, the big run up in savings that Canadians put aside as a result of the pandemic. And that also is a reflection of the very nice chart she showed of the expansion in mortgage borrowing by credit score. In general, we've actually seen through the pandemic, because of the exceptional fiscal and monetary measures put into place, employment numbers increase for relatively high wage professions in management, administration, finance, insurance, real estate. And unfortunately, most of the people who remain out of work are people in low wage service sectors where physical distancing is difficult. That's reflected in our mortgage market as well, where the people who are refinancing at lower rates are the people who could get mortgages in the past because of medium or higher incomes. And they're also people who are converting higher rate consumer debt into refinancings at lower rates in the current circumstances. And the people who have had employment problems are generally not the people who are in the mortgage market to begin with. So the employment effects of the pandemic, if anything, have only stoked housing demand further. We're not expecting policy rates to lift off anytime soon, though we are more hawkish than the market in most cases, with the expectation that the Bank of Canada is going to be lifting policy rates in mid-2022, and we expect the Fed will have to move a bit earlier than they've said. But in Canada, mortgages are typically written with a 5-year fixed rate. And even through the end of 2022, with those policy rate increases that we penciled in, for people who are rolling over a 5-year fixed term, they're going to be doing so on average at lower rates than their current mortgage sits at. So again, we could actually see the full 100 to 150 basis points of policy rate increases come through from the Bank of Canada through the end of 2023 that we forecast, not quite shown here. And we would still be in a circumstance where people rolling over mortgages would potentially be doing so at lower interest rates than they're paying right now on fixed term mortgages. So that balance sheet discussion really needs to be a critical part of defining, where countries truly are hotspots or where they're simply facing a combination of either sustainable or improving balance sheets and structural supply and demand problems. Even with those policy rate increases, we are not expecting 10-year yields to go, which are the benchmark for lending into the mortgage market here in Canada, to go much beyond the 2% range. And looking at what that means in Canada with comparison, some of the major markets we cover in the Americas, clearly the dark red line here, which shows Canada's house prices, has shown an amazing spike compared to the rest of the world. So, there is a great temptation here to say there is no way this can end in anything but tears. But that has been the anticipation for most of the last 15 to 20 years. And whether it's a bumblebee that flies improbably because of some sort of set of physics equations that don't apply elsewhere, or I would say, more defensively, we simply do have a real problem at the micro level in getting housing built, in getting densification happening in our cities, and getting services and transport with multiple levels of government aligned around servicing them. And that, combined with very low interest rates and an employment market that has favored medium and high wage earners, has conspired together to push prices up in a way that structurally looks quite sustainable. Looking across the Americas, it's worth keeping in context that real estate is actually a slightly smaller portion of GDP in Canada than in the US. Construction and mortgages are certainly high compared with the LATAM countries that we also cover. But with those structural factors in mind, they continue to look like non-worrying signals to us. The bigger worry is that so much capital needs to go into real estate over the next few years in Canada that we're going to see long-run potential growth dented because we're not putting capital into things that would actually raise productivity over time. Last note on the Pacific Alliance, you have seen a real stabilization in those markets, consistent with the mention earlier that countries that put forward large fiscal and monetary stimulus packages were able to keep their housing markets from maintaining a very long, drawn-out correction in the face of the pandemic. And looking at sales on the left-hand side in Chile, Colombia, Peru, they are, in almost all cases, with Colombia doing far better, back to levels that we saw in the formal markets prior to the pandemic. And construction, particularly in Peru, has really taken off. So looking forward in Latin America, the other factor that we think needs to be taken into account here is the outlook for financing costs, where real rates are set to remain very accommodative in Peru, Chile, and Colombia. Certainly less so in Brazil and Mexico, but we would argue there's a need to try to incorporate that household balance sheet analysis, forward-looking financing costs, and a really more granular effort on supply and demand to complement those price ratios that really dominate a lot of the indices, rankings, and early warning systems that you see, not just the fund, but from other sell-side research shops. I'll conclude there and stop sharing my slides, but thanks for letting me go into a little bit of a specific deep dive on some of the big issues that were laid out so nicely earlier.
Thanks very much, Brett. That was excellent exposition of why, in your view, we shouldn't worry about Canada's fever. Also a good glimpse at Latin America. Another country that was flashing, I think, I'm not 100% sure on Denise's chart, but certainly was in the housing fever list that Enrique showed, is Germany. So we'll turn now to Alessandro, who will talk to us about that case. He is an associate professor at the Carey School of Business at Johns Hopkins. He's an NBR and CEPR research fellow. He's associate editor of the JMCB. And of course, many of you will know him from his decade or so at the fund. And he actually worked on a very nice IEO chapter on housing, I think, during that period as well. So, Alessandro, one sort of question I had from Denise's chart also was, I kind of remember from the work of Giovanni Della Riccia and others that you really started to worry if there was a credit boom and a housing boom. The combination of that was sort of deadly. But if I understood Denise's chart correctly, that relationship seemed to be weakening. So perhaps you can tell us what the new thinking is on credit booms and housing booms, and whether this is kind of a twin problem or it's kind of a decoupling. Over to you, Alessandro.
Thank you, Prakash, for the kind introduction, for inviting me to join the panel. And it's great to be here with many former colleagues and people interested in this topic. Yes, I'll talk in the context of the overall theme about one specific case, Germany, which is a striking example of a housing boom without a credit boom. So what you see here on the left-hand side is a panel with a national rent price index and the price to ratio. And you can see that there is an inversion right around the global financial crisis. So the turning point is actually the first quarter of 2009, and it has not stopped ever since. On the right-hand side, you have two measures of household credit to GDP. One is specific bank credit, and then the second one is broader, including also non-bank credit. And you can see in the case of Germany, there's been a long-standing trend toward deleveraging or toward decline of credit to household as a share of output. And a closer look at the balance sheet or the household balance sheet help us getting a sense of what may be going on. So as you probably know, Germany has one of the lowest rate of home ownership among both advanced and emerging countries at 53%, around 50% on average, but 53% in 2005. And what is striking here that over the past 10 years, it has declined by 2 more percentage points, from 53 to 51%. And those of you who works on these know that these are not small changes. When we look at the composition of the household portfolio, the share of real estate in total assets is about half of the portfolio and going up by 1 percentage point. But if you look at the ratio relative to liquid asset, the increase is even sharper, so it's 4 percentage points. And when we look at household data at the micro level, with, of course, always concerned about external validity, but with more granular information on the distribution, you see similar changes in the composition of the household portfolios, even at the micro level. However, when you look at real estate to net worth, it's relatively stable, and is actually hiding the fact that overall household leverage actually declined by 3 percentage points from a value that is already extremely low. So an average, we start from 17% in 2005, and then we end up at 12% in 2019. So the framework that we are so used to
Alessandro, we lost you or at least I lost you.
And accessible may not be the best way to think about these cases where the level of mortgage market development is significantly lower. So in this sense, the German case is certainly not unique. Here I'm borrowing actually from the work by Eugenio, Giovanni, and one other colleague from their paper in Journal of Housing Economics. There, if I understand correctly, they estimated 20%, so about 18 out of 83 housing booms are not associated with credit boom. Another 25% are housing boom associated with boom in household credit, and the remaining one are associated with booms in private credit, so including both household and non-household debt. So here I'm using BIS household credit to GDP because it takes us at least to 2017. This is an average 2020-2017, so the post-global financial crisis. And you can see up here on the right-hand side, those countries that have high mortgage market development. If you remember that IEO chapter that you're referring to back in 2008 was making the point that mortgage markets are very heterogeneous, and you have more flexibility, more access to equity extraction, more flexible products in a few countries. So here you have Denmark, the Netherlands, Australia. I think this is Switzerland, Canada, New Zealand, Norway, Great Britain, Ireland, Portugal. Portugal and Spain are a little bit different than other European countries, than the US, Sweden, Korea, and Spain, and then everybody else. And Germany is actually here in the middle of the pack. This is another picture from the paper I mentioned earlier by Eugenio and Giovanni, and you can see that Germany again is in the middle of the pack with the same countries over here. So the triangle, the black triangle, is the credit in 2011, and the red bars are averages over 2001, 2005. So this is before the crisis. A similar picture come out from earlier work by me and co-authors in the JIE. Again, on the left-hand side over here, you see mortgage market to GDP. In general, emerging markets are really below 40%. You have only a couple of exceptions here. So some numbers from China, which in my opinion is the mother of all housing boom without credit booms. As of 2005, according to official household survey data, Chinese urban households were holding on average 1.4 houses per household with a standard deviation of 0.7. So that means that essentially the typical household has 2 houses. During the same year, same data source, 25% of all new transactions estimated to be for second and third homes based on this data. And then if you look in those data, the ratio of total asset to net worth is pretty much a straight line to 1, meaning that there is no leverage there. These are cash purchases. And for China, it makes all sense. China has been a repressed financial system for much of its reform history post-1980, and housing is the only market asset, the only asset that gives you a market return, and until recently was very much transacted on cash. And although this is not documented, actually, there is a lot of work to be done in this direction. In emerging market is very much the same. There is a very tight relationship between macro instability and house prices, because housing is a hedge. So how can this come about? Our paper, on which I based the first part of the presentation on Germany, is about one way in which unconventional monetary policies, and in particular quantitative easing, so purchases of long-term assets, are transmitted to the rest of the economy. The idea is that QE lower the return on safer assets like long-term bonds, and as long as housing return and bond return are positively and mildly positively correlated, there is substitution, and households shift from bonds to houses and other assets like equities. And for a fairly general assumption on the specification of the consumption function, one can actually show that this can lead to a consumption expansion, because the house price is going up, but the expected future return is going down. So this is an expected decline in the return on saving, and that translates in more consumption and more output. So this is precisely what is intended by the adoption of unconventional monetary policy, and in particular QE. We know that QE has had a great impact on asset prices globally, including house prices, and it is working, and it was working well. In the paper, we go a long length at documenting that this is the case. So this is one possible channel of transmission, and as it was mentioned in a couple of presentations earlier, these macro policies are one key driver of the big housing booms that we've seen globally, and certainly in these countries in which credit cannot be the main driver of the boom. Our work does not focus on explaining the boom itself. It's more about understanding the transmission mechanism. But indeed, it is a very plausible and very important, I think, channel of transmission. And I'll stop here. I have some thought about the financial stability risk, but I understand we're going to be talking a little bit about that later.
Thanks very much, Alessandro. Fascinating look at this kind of phenomenon of housing booms without credit booms, and the interesting thought that to some extent this is the intended consequences, one of the intended consequences of QE. I've noticed that a lot of folks, friends from various US industry sources here. Colleagues from the NAHB and NAREIT and National Association of Realtors, the CoreLogic, Evercore. So thank you all for being here. Perhaps I can invite Danushka, if you're still here, Danushka, maybe tell us a bit about.
Yes.
Yeah, if you wouldn't mind telling us about the U.S. market. The U.S. market was also flashing red on the screens of Denise and Enrique.
Yeah, I'll be happy to give you. Thank you for inviting me to speak here today. My name is Danushka Nanekar, and I lead the macro team at the National Association of Home Builders. Brett, thank you for your presentation. I will let my sister in Ottawa know that it is not a bubble in Canada. So I think Denise covered the housing market pretty well. It's the combination of decades of underbuilding, the favorable demographics from the millennials going into the housing, home buying peak years, historically low interest rates, the shift into housing because of the pandemic have pushed, the single family housing demand to the strongest levels in over a decade. However, on the supply side, what we like to call, Rob Dietz coined this, the chief economist at NHB, the 5 Ls. The lack of skilled labor in construction, high cost of building materials such as the lumber prices. Recently we did the calculation. The lumber price increase alone is adding $36,000 to a single family home right now. And the low availability of lots, lending for builders and land developers, legal issues in terms of regulatory costs. So all these burdens have contributed to the high cost of homes. And I think we saw that yesterday when the new home sales data came out. It was the lowest pace in a year. However, the prices have jumped 18% year over year because of high costs. And, the starts were holding steady, but we saw that the permits, overall permits for me has gone down. So I think this is a contributing factor because of the supply side issues. So at NH, we do focus on, just to give you a quick idea, single starts, we are estimating 1.1 million units, seasonally adjusted annualized rate. It's up, strong, but it's going to slow down next year because of the supply side issues. So we think it'll be around 1.14 million units. Multifamily, stronger than we expected. So it's going to be around 400,000 units. That's what we are thinking, but maybe lower next year because of the construction issues, around 409,000 units. So that's the NHB forecast that we have.
Thanks very much, Danushka. Anyone else from our US friends want to add something? Calvin, Frank, Richard. Calvin, go ahead. Welcome back to the fund. I think you're muted, or at least I can't hear you. I can't hear you yet. No? All right. Well, sorry. Anyone else want to chip in? I know Richard Foss is here, Dick from Evercore. All right.
I'll mention something that I think was a really great presentations by everyone. I found it really interesting. And I think Denise had a slide comparing houses with apartments. And that's a trend that's really been very interesting to observe, not just here in the U.S., but in other markets as well. And it affects both prices and rents. So what we've noticed is that during the pandemic, a big, perhaps not surprising, but a big shift in the population moving out of some of the center cities to more suburban locations, increasing demand for single-family detached. Single-family detached generally has the larger quantity of living space inside the house, as well as some green space around the house. So when we look at it by structure type across residences, comparing single-family detached with single-family attached and with multifamily, we see the strongest demand for single-family detached. That's where the house price growth has been even strongest in that segment, and single-family detached rent growth has been the strongest. Next, weaker is single-family attached, and then at the other extreme, it's multifamily, where if you look at high-rise buildings in the downtown center city area, effective rents are actually down, and depending on the market, prices may be down too. Now, multifamily is a big segment too. So if you look at the garden-style apartments that are more in suburban locations, those have held up better than the tall, big high-rises in densely populated areas in downtown cities. So really interesting contrast, and it's interesting in Denise's slide to see how that pattern seems to play out in other countries as well.
Thanks very much, Frank. Alvin, you want to give it another shot or no? I still can't hear you actually.
Hi, Prakash.
Turn back.
It's Richard.
Hey, Richard, go ahead.
Hello, everybody. And thanks very much. It's a bunch of great presentations. It's very thought-provoking. One of the innovations in this housing cycle that's been very strong in the U.S. and I believe in other places has been the application of forbearance, which really sort of switches the timeline of how this is working. And insofar as we have a business cycle that is strong, but still employment is below where we were a year ago as this runs out. Does anybody anticipate volatility during this period, which should be the end of this year, early next year here? And is this a widespread global phenomenon? I've heard some stories about other countries applying this, but is it widespread? I'll mute because I don't know where the noise is coming from, but thank you.
I can speak a bit on this from the work we do in Canada and the US. Generally in the wake of the 2008 financial crisis, banks, increasingly have to provision for the future based on forecasts of the next 2 to 3 years or so. And across Canadian banks and across US banks, they have been generally releasing large tranches of provisions that were put aside last year. And so, the broad anticipation revealed by that is that the forbearance they provided was successful. The vast majority of loans on which provisioning was set aside have not needed to tap it. And while, there's likely to be a small hiccup as we move through the transition from various emergency supports, the revealed action of financial institutions is they don't see, strong losses ahead as that transition occurs.
Thanks very much. We have about 8 minutes left and 4 panelists. Maybe I'll go back to the panelists and give them a couple of minutes each. I think all of you took the question that we posed, is it time to worry, and gave, I think, sensibly two-handed pros and cons answers. I want to come back to you and see if I force you to favor one hand over the other, would you say, is it time to worry again? And also any other closing thoughts or remarks you may have. Let me start with you, Denise. And perhaps, Denise, you also were mentioning that you were a bit worried that perhaps with the end of the foreclosure moratoria and forbearance, things could change. So perhaps you could elaborate on that as well.
Thanks, Prakash, and great to see so many familiar faces as well. Thanks for all the nice comments. Well, on the foreclosure or forbearance, more importantly, I guess we're gonna need to wait and see. And we have looked. I didn't show it in my slides, but we have looked at the existing so far where the developments have been, and we don't quite see a spike. But that would all depend on, I guess, the dynamics is going to be such that even as those measures are transitioned out, if the economy is doing well, if employment gains are continuing, we're going back to some kind of normal, things can counterbalance, and we might not have the kind of foreclosure or default wave that we were concerned about. But on kind of wrapping up the whole thing, I would say, I guess in my presentation, as I said, I tried to balance things a little bit. The bubbly, as Enrique said, formerly bubbly cities, where they stand, we need to keep watching those. On the macro financial risk, traditional way, as Alessandro said, as Brett pointed out, this dynamic between credit growth and house price growth, I do find that especially comforting. Another thing I find comforting, right before the pandemic, we put out a paper that was bringing in the real side of things, if you would, and looking also at construction activity in addition to house prices and credit developments with Giovanni and a couple of other colleagues. And it's the, if you would, the triple whammy of all things. When construction is also going up very fast, then you're pretty much doomed, right? And again, this time we're not having this, we're not seeing this. If anything, it's the opposite side, right? We talked about the supply side constraints and why we're not seeing the supply side coming up. So I guess on the balance, on the macro financial, I'm not losing sleep over that. What I'm much more concerned about is what could be the implications on the social side, on the labor market side. We are hearing, anecdotal, interesting pieces of news, like 40% of workers in the U.S. are thinking about quitting their job. And if you're thinking about, you're in your 60s, 50s, and you see your house prices, and Shko was saying, house prices increasing so much, would you rather just sell, downsize, and shave off a few years and then retire now? We don't know. This move from urban core to suburban areas, are we going to see a gender imbalance in the sense that we're going to see more women choosing to quit, stay at home, or work part-time, and be able to do so because housing costs are now lower, right? So these are all open questions with very big implications that I hope we won't be blindsided and we will start to think about now.
Thanks very much, Denise. You put some thoughts in the mind of this 60-year-old. Brett, let me perhaps turn to you. And for Canada, as Danushka's siblings, I'm happy to hear that my siblings in Toronto are going to be fine. Can I ask you a bit about as you wrap up also, about the housing affordability issue? I mean, provincial governments in Canada were kind of putting in place capital controls to keep housing affordable for their citizens in the face of what they said were speculative flows of capital. Is housing affordability an issue? When I devised the title, "Is it time to worry?" I had the financial stability in mind, but should we be worrying about housing becoming unaffordable for the middle class and others? Over to you, Brett.
Absolutely, and that's a point I want to underscore. While in responding to your question in the same way you mentioned, in terms of financial stability and not seeing financial stability concern here, I do think there is a long-term growth potential concern, as I mentioned, because so much capital is going and needs to continue going into Canadian housing in order to bring prices in line with incomes in a way that will ensure greater affordability. There is a broader social stability concern that I alluded to around the discussion on immigration, where Canada thinks of itself really since the 60s and 70s as a country made up of immigrants, where multiculturalism is not just an ethos, but an endorsed policy. And maintaining that social license for higher immigration numbers is going to require movement on the supply side on housing to ensure that high or affordable housing prices are not linked to pressure from immigration and therefore a negative feedback loop on the political side. The time to worry, I think, in a country like Canada, I think to some extent, New Zealand and Australia, which are all three very similar countries, and to some extent, in terms of the county by county analysis presented, is around the difficulty in bringing together multiple levels of government to actually ensure that planning, zoning, approvals, and then construction can actually happen to respond to these price pressures. We are finding that coordination difficult in Canada, and I can't say that we are moving quickly to resolving it. And so I am worried that those affordability concerns, which have longer term social cohesion worries attached to them, and a long-term productivity and potential growth concern, are the things we need to worry about most pressingly right now, rather than a financial stability concern around housing.
You're muted, Prakash.
I said we were out of time, but let's run over about 5 minutes. So 2 minutes for you, Enrique, 2 minutes, Alessandro. Enrique, from a financial stability perspective, is it time to worry?
The way I would approach that question is we are, especially if I put my central bank hat on, we always have to worry about the scenarios in which this is a concern. Do I see this as the major concern right now going on and spilling over from housing markets? Probably not. And I think Deniz has given a whole list of reasons why this time around things seem to be on a better footing. That doesn't necessarily mean that there is no connection between financial stability, monetary policy, and the potential heating up of housing markets. So a lot will rest, I think, going forward on the availability of tools to deal with those imbalances, macroprudential tools, and the path that fiscal and monetary policy take going forward. So long-winded answer to say there is a great deal of uncertainty on that, which comes on top of some of the bigger questions that that both Denise and Brett have mentioned, which is some of these structural shifts in housing markets that are taking place, part of it reflecting changes in lifestyle, demographics, and so on, that are going to be for us to ponder and that can potentially play very significant roles in how the housing market shapes up over the medium term. So I'll put the emphasis, or I will reiterate what both the panelists have said already on that regard. We should not drop the ball on that discussion.
Thanks very much.
You.
Alessandro, you have the last word, 2 minutes.
Thank you, Prakash. So on the one hand, as I think has been said before, we should always worry about these things. So we can't just worry when it gets in orange on red zone. So on the other hand, right now, no, like Denise, I'm not worried from a financial stability perspective. I am very worried about housing affordability, and more specifically about the redistributive impact of monetary policies and quantitative easing. We are having a big debate about whether or not we are at risk of a persistent inflation uptick. And as you all know, the imputed rents are a very big chunk of the CPI, not only in the US, but everywhere else. We're looking at that debate from the perspective of the standard 1990 framework, where we know what the output gap here is, and if there is too much demand in the system, we need to lose a monetary policy. But the post-global financial crisis taught us that that framework is not the one useful to read the current situation, and COVID has made it all more complicated, because now there is also a tremendous difficulty in reading the supply side of the economy. In this context, understanding understanding what monetary policy should do, what it is doing, and what are the implications for housing is tremendously important, but also very, very difficult. And so that's my main worry. We heard it in the case of Canada. In my German data, who is selling, who is losing homeownership are at the low end of the distribution, who is buying cash for investment purposes are high net worth household. So that's what I think. And we have seen the spillover into politics over the past 5-8 years. And that's, to me, is really the biggest worry here.
Thanks very much to everyone. Excellent presentations, excellent discussion. Thanks to many of friends from the US housing industry who attended. We perhaps will do a special another event with you focused on the US. Thanks also, I see Jean-Charles from the Banque de France. So maybe we can do an event together as well. So I'm very gratified that there was so much interest in this event. We had lots of participation, nearly 150 people at the peak. So clearly a lot of interest in this issue, and let's see if we can keep this discussion going. Thank you, everybody. Bye-bye.
Thank you.